In our outlook, we talk about a preference for securitized or collateralized risk over unsecure or sort of more generic forms of corporate credit. And you mentioned it up front. So how are we thinking about that on a go-forward basis?
Sure. So I use a non-government guaranteed mortgage as an example of sectors that caused so many problems during the last major crisis pre-COVID, which was the global financial crisis. Post-global financial crisis regulations, investor conservatism, rating agency conservatism have continued to create strong relative opportunities to source this type of risk. During periods where central banks had a lot of flexibility and where the economy was quite strong, you didn't necessarily need that extra protection. But given the world we live in today of extreme uncertainty, that extra protection can be sourced at a relatively low cost. One example is just to take a look at a typical seasoned bond backed by non-agency collateral. What you'll see here is what the loan-to-value ratio has done over the last several years. You're at a point today where, because of the big increase in housing valuations in the United States, but also in other areas of the world, you've taken an instrument that was once quite risky and have turned it into an investment that is very, very low risk, because the average loan-to-value ratio, the average borrower equity across these pools can be as high as 50% or even greater. And I bring that up because there's certainly scenarios going forward where home prices stabilize, home prices go down. And again, this is just a proxy for the type of opportunities that can be sourced in the collateralized markets, in the securitized markets, which we again think makes a lot of sense, given where we are within this cycle.
Thanks, Dan. Now, moving on to another type of mortgage, agency mortgages. You mentioned them up front. Briefly, what's your view on current valuations?
Well, they're looking attractive, and there's some technical reasons for that, and there's some fundamental reasons for that. One of the fundamental reasons for that goes back to the fact that interest rate volatility has been very, very high. And as an agency mortgage investor, you'd prefer, realized volatilities to be on the low side. But also the reason these instruments have become quite attractive is that the Fed has been very public in their intention to stop expanding their balance sheet through the purchases of agency mortgages, and perhaps in the future begin to reduce their exposure to this asset class. As always, markets anticipate these events, and you've seen significant widening in what is a very high quality, very liquid asset. So from an option adjusted spread perspective, agency mortgages are looking attractive, and they're increasingly representing an attractive alternative to investment grade corporate risk or other segments of the market where you have a little bit more downgrade or default exposure. So this is a sector where we've had significant holdings throughout the many decades of operating within these markets. We significantly reduced exposure as the Fed purchased a larger percentage of the available float. And now, given their intentions and the widening we've seen associated with some of the interest rate volatility of late, we've begun to add back to that sector of the opportunity set. And then also in terms of agency mortgages, in terms of what to target, perhaps not surprisingly, the greatest weakness have been in the coupons that the Fed owns a lot of. So we still think it makes sense to leverage the team, take a very strong relative value approach to this sector, and focus on opportunities where the Fed is not going to be selling, or at least not selling to the same degree. And a lot of these are in some of the higher coupon mortgages that also provide a little bit of cushion in certain instances from rising interest rates. So it's just an attractive sector, or a sector that's getting increasingly attractive from an overall return perspective. So attractive, we're not rushing into this space. We think you can be patient, given concerning technicals. But again, a sector that PIMCO's liked for many years that looks, again, increasingly attractive.